Hi, and welcome to my channel. For those of you new, these videos will be a mixture of tracking my journey and development towards financial freedom, about basic personal financial products, and also about improving people's financial well-being. My name's Dave and I work in financial services, and it amazes me the number of people I speak to on a day-to-day through my employment who do not understand the basics of personal finance, because we don't teach the subject in schools, or in the UK we think the subject matter is taboo to talk about. Remember, if you like the videos on this channel, press the like button, subscribe to this channel so it can grow and reach a wider audience. Now let's get on to this week's video. So this week's video is about a review from my ISA account during the month of May. So start values, end values, dividends received, contributions, fees, summary of the shareholdings we hold, and the reasons and the aims of our portfolio moving forwards. Now, it's not to boast or brag, it's to give people an oversight of my journey towards creating a financial freedom moving forwards. The aims of the portfolio is a growth rate of 10% for the year, annual dividends of £500, and a year-end value of £50,000. As we can see from the graphics, we started the month at a value of £47,088. We finished the month in a very healthy position of £48,413, a profit of 1,325%. Now, to the year to date for April, we were up 12.93%, and at the end of May, we were up 13.4%. So a much better improvement due to a market rally than our 10%. So hopefully we will carry that investment and aims moving forwards, and the portfolio will be in a very substantial and healthy position at the end of the year. During the month of May, we made contributions of £1,166.54, and we received dividends of £159.32 towards our total, as we said, £500 of the year. Quite a good few dividends. Aviva gave us £41.02. Lloyds Bank gave £57, and Legal & General gave us £61.30. Now, we've not decided to reinvest any of them dividends. What we've done, we've tried to diversify, so we put that into one fund, which I'll discuss later on. And in relation to fees with our provider, monthly fees of £9.82. Now, quick overview of our shareholdings. We own 9 shares in the portfolio, 7 in profit, 2 in loss. Our shareholdings make up 34% of our portfolio, of which 30% is in the FTSE 100 and 4% is in the FTSE 250. And a quick overview of our shares, as we can see, mainly cyclical shares of financial services, as the graphic shows, okay, but we are aiming to diversify away from UK, away from financial services, moving forwards, and create a more balanced portfolio. And a quick overview of the major shareholdings we hold. Our largest shareholding is Lloyds Bank. We own 10,000 shares, £4,989. Very nice month, made £450 profit. 10% of our portfolio, but we're still showing a loss of 70%. But long-term shareholding, Lloyds will hopefully increase dividends, and hopefully when the market recovers, inflation picks up, margins will increase, and a long-term holding for our shareholders. Our next biggest shareholding is Aviva. We own 680 shares worth £2,800. Now, during the month, we did increase our holdings. We did buy another 265 shares at a cost of £1,000. Makes up 6% of our portfolio, and the profit so far to date since purchases is 11%. Again, Aviva is a long-term hold, been on a recent restructuring plan, but hopefully dividends will increase, and a very good long-term shareholding. Currently we're trading below net asset value. Our next shareholding is Barclays Bank. We own 1,172 shares worth £2,140. 5% of our portfolio, showing a very nice profit of 43%. Again, will increase dividends, margins will hopefully improve. Banking sector and the UK will obviously recover from the pandemic recession, shall we say, but a long-term hold on, and hopefully will give us some very nice dividends in future. Our next shareholding is slightly off a beaten track to other portfolios so far. Sainsbury's, the retailer, we own 598 shares, £1,600, 3% of our portfolio, showing a slight loss of 4%. But again, a long-term hold. Everybody needs food, dividends are being increased, and hopefully margins will recover and pandemic costs will hopefully be reduced and balance sheet profits will be increased and improved moving forwards. Our next shareholding is Legal & General. We own 485 shares, £1,400, just under 3% of our portfolio, showing a very nice profit of 38% since we bought it. But again, like Aviva, a long-term hold, got great track record and improvements in the insurance and the pensions and investment market, and does pay a very good dividend. Our next shareholding is AJ Bell. We own 237 shares, £1,000, up 10% when we bought it. Did have some very good results in the month. A lot of new customers, a lot of younger customers, but assets under management have grown. Some great figures, but again, a long-term growth company. And it did produce results, paying just over 2 pence as an interim dividend, 6 pence in total, but again, a long-term growth company. Our next shareholding is HBOS. We own 231 shares, £1,000, up 11% since we bought it. Somewhat struggled lately, but a worldwide bank, and hopefully moving forwards will reinstate quarterly dividends. Hence the reason why we've bought them shares in the past. Okay. Our next shareholding has somewhat suffered recently, Card Factory. We own 1,126 shares, £770, down £200 in the month of April. Slight issue of restructurings, but now shops are open, hopefully make some cash rich money, and it will produce results I think on the 8th of June. So hopefully we'll give an update about restructuring, how the shops are performing, and hopefully on the long term it will reinstate dividends and also special dividends. And then our smallest shareholding is NatWest. We own 252 shares, £521, up 4% since we bought it, but it makes up 1% of our portfolio. It was in another platform, we brought it in to simplify our accounts, but hopefully moving forwards, as again, banks will improve, and also the government will hopefully reduce their stake, and it will return to profitability moving forwards. But again, a long-term shareholding. So that's a summary of our shares. That we own 9 shares, 7 in profit, 2 in loss, but hopefully all the shares are bought for a long-term reason. We've got no reasons to sell in the shares, hopefully in the next 3 to 5 years, but moving forward when the markets recover will give us some very nice dividends and hopefully reach that target of £500 a year, which will be reinvested back into the portfolio, whether it's to existing shareholdings or to create diversification into some of our funds, which we'll discuss in a few minutes. To discuss the funds held within our portfolio. Now, all the funds we hold are all what we call active managed funds. We do not hold any passive funds at all. The reason for that is obviously I'm prepared to do my due diligence and homework, pick my own funds based on past performance. And the aim is that although we will pay some higher fees, we will hopefully get greater returns which match our plans for 10%. Obviously some funds will do better than others, but again across the board hopefully give us a target of 10% annual return. Now in a very good position, we own 14 funds and all 14 funds are in profit. Again, our portfolio is based, but 66% of our portfolio, roughly £30,192, is based upon UK funds, of which the portfolio 57% is in the UK, 23% is in America, and 20% is in Asia. Moving forwards, hopefully, we will diversify and we will move towards US, Asia, and European funds moving forwards. Now on that basis, we have purchased or increased one of our existing funds. We put £200 into the BlackRock European Fund. The fund's now worth about £1,500, 3% of our portfolio, but showing a very nice profit of 29% since we bought it. But it was done to increase one of our smaller shareholdings within the portfolio, and hopefully Europe will be on a good recovery, and the reason was done for diversification. Now, I'm not going to go through all 14 funds, but just a quick overview of our top 5 holding, the reasons why we hold them and what we think moving forwards. So our largest fund is a China equity fund, £3,800, nearly 8% of our portfolio, profit of 8%. China was one of the first companies to recover hopefully from the pandemic, a great growth company moving forwards, and will hopefully carry on that way moving forwards, and it will give us some great growth potential towards the portfolio. Our next largest fund is a global equity fund. Again, £3,800, 8%. We are up 25%. Slight reduction in the last month, okay, but again, a very good performance, a lot better than our 10% expected, but it was done to diversify the fund. Our next largest fund is Ballet Gifford Positive Change, £3,700, nearly 8%, up 24% since we bought it. Has very few select number of companies, but all excellent companies, and say a lot of long-term hold based upon the ethos and the investment ideas in that fund. Our next fund is a Legal and General Technology Fund, £3,600, 7% of our portfolio. Again, slightly reduced this month, but up so far to date 46%. Obviously, the technology firms in the USA, great returns the last few months. Hopefully it will continue, hence the reason buying that share. Our next portfolio is the US smaller companies, £3,000, 6% of our portfolio, profit to date of 22%. Hopefully it will give us some great returns in the US moving forwards. And our next fund is in the UK, UK Smaller Companies Fund, £2,700, 6% of our portfolio, profit to date 9%. It was bought, hopefully UK smaller funds will give greater returns than the FTSE funds and a long-term hold. And then we go down to our smallest funds, a fund solely predominantly in Russia, £553 is the value, 1% of our portfolio, showing a profit of 10%. So we do own 14 funds. Other funds we do own. We own some emerging market funds. We own a second global equity fund. We own a European fund, which we've topped up this month. We own a mid-cap fund, and we own an AIM fund. So hopefully through the idea of the 14 funds, it will give us greater diversification, because some funds will perform better than others. But ultimately the aim of the portfolio is a 10% return year on year. And just like our shareholdings, we aim to hold these funds for the next 3 to 5 years, unless fundamentals or managers may change, or there may well be some sentiment, but they will be reviewed on a regular basis. But they've all been bought based upon past history, due diligence, and the idea is to diversify the fund away solely from the UK. So as we've said, the fund's performing very good to date. The portfolio is up over 13%, well above our expectations. Hopefully growth will continue towards the end of the year, and we'll reach our targets. Remember, if you like the videos, smash the like button, subscribe to the channel, and we'll see you again soon for the next video.